Hello, I'm Hansley from Livewire Markets, and welcome to Fund and Focus. Our guest today, Frank Danieli, the head of credit investments and lending at MA Financial. We're going to be discussing the impending launch of the MA Credit Income Trust, which is coming to the ASX a little later this year. Welcome, sir. Good to have you with us.
Great to be here.
So, as I said, you're about to launch your first ASX-listed private credit trust. For those who do know MA Financial, you've already got a big array of unlisted products in that space. So, I guess my question to you is, why are you listing this strategy and why now?
MA1, the listed investment trust that we'll bring to market, is in fact client-led. Some of our clients are happy to participate in our unlisted funds, but they either want something that's a bit more liquid, that they can trade on a daily basis, that they can move in and out of more frequently than you can possibly do in a private fund. And they've been asking for this. So we've been asked for quite a while to bring something like this to market. And that's what MA1 is. MA1 is an access point on the ASX for the first time where investors can participate in what is a $3.7 billion portfolio of our flagship private credit.
Lots of private credit investors sound the same when they talk to me, talk to us on the team about their investment philosophy. So what do you think MA Financial offers that gives you an edge over others in the space?
Yeah, well, I'm glad you said that because I actually agree. And I'm not going to sit here and say, look, we've got a deep team and they're very experienced, we have good track record, because we actually have that. And I think about those things almost as a hygiene factor. It's a foundational thing that you have to have in order to have the responsibility to manage money as a fiduciary. So assume that that's just a foundation. That's not what I'm going to say is differentiates us, in fact. There's probably three things I'll call out that really differentiate MA, in my view. The first is alignment. The second is proprietary deal flow. And the third is workouts. So I'll just touch on each of them, I guess.
Sure.
In the first one, alignment, this is really core to MA. So while we are ASX listed ourselves as a manager, we're 30% owned by staff. And we believe in co-investing in our credit products with our clients. We've now, the firm and its staff have invested over $190 million in all our private credit strategies. And that actually includes about $160 million co-invested in the underlying portfolio of MA1. So we really believe in eating our own cooking alongside our clients. And we think it's really important as a manager of money that we're an investor too. I said we do proprietary deals because we are an investor as well. We have focused on the type of private credit where we go out and source and structure loans ourselves, that we set up these origination opportunities to bring loans into our funds, and we're the one doing that. We set terms, pricing, covenants, we write the loan documents ourselves. That's really core to us. We think that if you're not doing proprietary origination, an investor might as well be, buying a bond in a Bloomberg screen. We want to do something that's different and really step in to replace a void that we believe is opening up in the lending markets as banks scale back. And then finally, I said workouts. It doesn't mean that I'm out there working out myself. You can tell that. In fact, workouts, I think, is actually one of the most important things in credit. Our philosophy around credit is about avoiding losers and not picking winners. We are not the equity here. We are a lender. We want to get our interest that's contractually owed, and we want to get our money back, and that's it.
You've been keen to point out that you've already raised over $170 million in cornerstone commitments so far, looking to raise $300 million. But I'm glad this point came up because it leads to a question I've always wanted to ask people who are in the private credit space, and I'm going to be asking it to you. Who is backing you so far?
It's actually quite diversified. There's over 60 different investors and investor groups that represent that $170 million. So we like to have a diversified loan book. We have a diversified investor book. Our investor base spans private wealth groups, so wealth groups, financial advisors, advisory groups, family offices, high net worth individuals, and so that's really the base of investors that have participated us. It's our existing clients and our existing relationships that are backing us with this new product in that cornerstone demand. It's been great.
Yeah. Okay. Excellent. So you say as well that this product will offer, it'll offer lots of things in it. As you said, 160 odd items, or 160 odd investments, I should say. But you say that product will offer asset-backed lending as a differentiator. So for anybody who isn't familiar, in case they're watching this, what does that mean and why are you pursuing it?
Asset-backed lending means financing whole portfolios of loans out there in the real world economy. So it can be things like certain types of home loans, car loans, either to people or businesses. It can be business loans, it can be asset finance, equipment finance, and then things that are a bit more specialized like receivables or supply chain finance. Why we like it is that you get to finance a large, diversified, granular portfolio of loans. You don't just exposed to one thing. You get a good cross-section of the economy. In a way, you can sort of do kind of like what a bank would do on its balance sheet. You can build a portfolio that's exposed to a whole cross-section of the economy, lots of different types of things. You can weight up and weight down into certain sectors as you go through cycles and as the world changes, as you see different trends and themes. What we're doing in that space is that we're going out, working with a specialist finance company to find these origination channels and structuring something up where we can finance these loans. And we actually do it often also in partnership actually with banks in providing this capital. So banks aren't in fact our competitor in that space. We're really partners in working together to efficiently provide capital into the real world economy.
You talked to asset-backed lending a little bit ago. That's, I think I called it was about half or over half of the portfolio?
About 56%.
About
today,
56%, okay. So there's obviously another 44% that we haven't talked about. What are some of the other investment ideas you plan to hunt down?
Yeah, we really like two other areas. Direct asset lending. That is where we go and provide a senior secured loan to a real asset, so secured against a real estate asset. We like to do that at a sensible loan to value ratio. That's about 40% of the portfolio. So you add that up, about 96% of MA1 is asset-oriented lending. That's really core to our DNA. We also do lend to companies, so we do direct corporate lending, and that's a smaller proportion of the portfolio, about 4% today. We have a target range of 0 to 30 there. When we're lending to a company, what we're doing is we're taking security over that company. It's usually a larger company, and we're taking security over the business and looking at its cash flow generation potential to service our loan and to pay us back.
You spoke a little bit earlier to risks and wanting to avoid losers rather than picking winners or outright picking winners. Let's say then that inflation sticks around for a lot longer than anyone expects. The next move for interest rates is up rather than down. The consumer gets crunched. We get an even bigger default wave that hits corporate Australia than what we've already had. What would you do to ensure your clients don't bear the brunt of such a financial crisis? I know that's a pretty extreme situation, but it's one I'm sure you have to think about.
There's a great saying by Warren Buffett that we've actually always really liked at MA, and it's predicting rain doesn't count, building the ark does. So we do not have a crystal ball. I don't know whether all those things you've articulated are going to occur or not, but they could. And so we need to be prepared for that. So we're building into our process a range of risk mitigation features to do just that. And then we test it. So we really actively manage our portfolios on a day-to-day basis using a range of data that we have access to, tools that we've built internally to monitor for such risks, and also just a qualitative lens from the commercial experience of our teams. And as part of that testing, we also run a series of simulations on a regular basis. We do something regularly we call war games, which is a massive stress testing exercise across our portfolio where we're simulating three extreme economic scenarios, a moderate recession, a severe recession, and then a financial crisis or an economic depression on all of our loans. And we see what happens, which ones could be at risk, which ones wouldn't be, how we deal with that scenario, and we run a range of discrete and investment-specific risks on top of that. The whole idea is we don't know what's going to happen tomorrow, but we want to make sure we're prepared with a break the glass here plan, that if those things do happen, we've got the best chance to go in and protect investor capital, which is ultimately our job.
How will shareholders receive value by owning this trust?
Yep, MA1's all about monthly income distribution. We're targeting a return of cash rate plus 4.25%, which is today 8.6% per annum net of all fees to investors paid on a monthly basis. We're also implementing a range of capital management mechanisms, including quarterly off-market buybacks and the ability for on-market buyback activity as well to support the vehicle.
Okay, so that's the value. The last question that needs to be asked when we talk to private credit fund managers and money managers, transparency and reporting is still, I would argue, a nascent challenge for the industry, especially for newer firms. I'm not saying that MA is new or nascent in that regard at all, but how do you report to your investors and how transparent are you prepared to get with investors?
Look, we really believe in transparency. We're trying to do it here for MA1 at the outset. We've disclosed a range of information about the underlying portfolio of MA1, what is in that $3.7 billion portfolio that it has exposure to at the outset. We talk about the lending segments, the underlying loans, the characteristics, the key statistics in each of those verticals of direct asset lending, asset-backed lending, and direct corporate lending. So we're hoping to bring that level of transparency to the market. In our existing funds, and we'll do the same for MA1, we do monthly investor reporting. We try and do quarterly webinars. We're going to do an annual investor day. So we really want to engage with our clients. It's core to who we are. We believe in transparency overall. And finally, I'd say we also believe in transparency of process. It's not just about what's in our portfolios today, but it's also about how we do what we do. We don't want it to be a black box process. We want to talk to people about it, to talk about our war games or our red team, our investment process. And we put out a whole series of collateral on this, and we've got a private credit insights series at our website at mafinancial.com, which cover all of that and really lets investors go behind the scenes, which we believe in.
Frank Danieli of MA Financial, thank you for coming and explaining it to us, and good luck for the launch.
Thanks, it's been great, and thank you for the time.
And thank you for joining us. If you enjoyed that interview, you can subscribe to the Live Wire Markets YouTube channel, as well as our website, where you'll get more great content like this every single week. Until we see you next, take care and thank you for watching.